Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Nashville. Here we go. This is our PRMG Leadership Conference. This is for the retail channel. Just got here a couple hours ago. I just had Hattie B's, the Shut the Cluck Up hot chicken. It's very hot. I survived the hottest chicken in town. It's really good. Our retail leadership conference is pretty cool. It's about 3 days, and it's basically trying to get 175, 185 leaders together that run retail branches. And, retail channels are very purchase heavy and distributed retail, and it's a purchase market. So we're talking about how to scale our business, compress time, grab technology, and just lead. So lots of room for lots of different business models in this industry. And we flew all of our branch managers out here for this 3-day conference to do it once a year. So it should be fun. All right. Job support came out. Job support came out on, sorry, I don't want to see that guy. Woo. There's literally, it's Monday night. So I don't know why it's so crazy here. Anyway, the job support came out on Friday, and it was mostly positive that the labor market's still very strong. Now, what's interesting is there was about 15 or 310,000 jobs created, and the estimate was for 300,000 jobs. Now, what's interesting is the labor market participation rate there are more people entering the workforce because it's so strong. So when you have more people enter the workforce, the unemployment rate actually goes up. So, Corvette. There's like 750,000 people in the household survey, which is part of the jobs report. There's 2 surveys, right? There's the household survey and there's like a business survey. And the household survey had more people entering the workforce. That's a sign of strength. That's a sign of a strong economy. So don't forget that we're in the middle of this, no man's land. Are we fighting inflation? Are we going into a recession? Are we having slowing growth? Is recession as bad as people think it's going to be? Is it not bad? Is inflation peaking and going down? This is basically what everyone's trying to figure out at the Fed. And they've got basically 2 tools to handle that, and that's raise the federal interest rate, which, as we know, there's a meeting coming up in a couple weeks. And if you go to the CME tool, there's a 60% chance. I look thinner when I move the phone away. There's a 60% chance that the Fed will raise by 75 basis points based on future contracts on that CME tool, if you go check it out right now. And that's where I think it's going to be. I don't think they're going to go down. That would be a sign of pivoting. And so the Fed is basically, no, I'm good. I'm literally filming a video, you idiot. Jesus Christ. It's like, there's weird people out here, man. So the Fed is going to go up 75 basis points. And then they're going to look and see, has inflation peaked? And the PCE is a really big indicator. CPE, these are core readings of inflation figures of what consumers pay. Now, in July, it was 4.6%, down from a peak, I believe, in February of like 5.6, I think. I don't have the numbers correctly, but I know that between May, June, and July, the numbers have been coming down for the inflation figures that the Fed looks at, PCE and CPI. So maybe inflation has peaked. I don't know. The Fed's not going to take any chances. They're going to keep raising rates to make sure that the economy doesn't reboom again, and then we have issues. They only can destroy consumer demand by raising rates and making everything more expensive, as we're noticing in the housing industry right now. So we're noticing the rates are up. We're noticing that demand has been reduced because of higher interest rates. And if you look at your credit card statements, if you look at car loans, everything has gotten more expensive because the Fed is raising rates. And starting this month, the Fed is now doing what's called quantitative tightening. So last week, the Fed got rid of $20 billion of mortgage-backed securities off their balance sheet. I think they own like 2.7 trillion or something like that, just in mortgage-backed securities. 20 billion in a week. And they're supposed to do something like 95 billion a month of quantitative tightening between treasuries and mortgage-backed securities. That is tightening liquidity in the system. And, margin compression could be even worse for us in the mortgage industry. I don't know. We're going to find out. Obviously, there's some uncertainty. And then, of course, will all this demand destruction create a recession? That's the other thing we don't know about. So, but again, the job support was really strong. And even if inflation has peaked, it's still high. Will it remain high, or how quickly will it come down? I'll say one thing about the job market. The LinkedIn is a great place to find a job. And I read a pretty incredible article the other day about the history of LinkedIn. So basically 20 years ago to this month, LinkedIn was created. There's a guy named... Yeah, I almost got smoked by a Lambo. Anyway, this is the most exciting LinkedIn video I've ever made. Thank you, Las Vegas. So Reid Hoffman and a group of investors in 2003 had a Series A round for LinkedIn for $12.5 million, $12.5 million, just $12.5 million. They sold it to Microsoft for $26.2 billion in 2016. Last year in 2021, by the way, in 2016, the talent acquisition section of LinkedIn made about $960 million. And that was part of what Microsoft really saw in it. In 2021, LinkedIn had $10 billion in revenue. $10 billion in revenue just 5 years after Microsoft purchased them for only 26.2, which at the time seemed insane. So the healthy job market's out there. People are looking for jobs. If you watch the LinkedIn news, they actually said that jobs were up 7% last month. And, there's some stats out there that Gen Zers, 24 and under, are hanging on to jobs for about 2 years and 2 months at a time. Millennials are hanging on to jobs for about 2 years and 9 months on average. So there's a little bit of that. It's a very liquid and fluid labor market, but it's still very strong. And demand destruction is still happening with higher rates. And also, inflation may have peaked. Is this what a soft landing looks like? I don't know. All I know is we're going to grind every day, find ways to scale and build your business and do more purchase money, loans, and build our communities together and try not to get hit by a car. Cheers. Hey, it's KP coming to you live from Nashville, Tennessee. Broadway. That is AJ's, Alan Jackson's. And we had a great event there last night. Thank you, Appraisal Nation, for putting it on for our PRMG Retail Leadership Conference. Here we go. Thursday night after the first football game, I didn't even leave my room until 9:30, sadly, because I had a conference for 3 days and I had to catch up on work emails and phone calls. So I'm getting a late start here. 2 a.m. Central Time. It's only midnight back home, which is about normal for me. So we are seeing a lot of changes going on with demand destruction, even though the job market is still very strong. And I hope my audio is good, so I apologize in advance if it's not. I went to my earbuds tonight, so if another Lamborghini tries to take me out, I won't even hear it coming. I will tell you that the job market is very strong, And that is holding up the economy. And housing is very strong. And that is holding up everybody's balance sheet. Oh shit. I apologize for what I just saw. Hello. I feel like I was just in New Orleans, okay? So let me just say that. By the way, I want to say that Jeff Bentley, the CEO of, I believe it's Northwestern Federal Credit Union out of Virginia. I might not get that right, but he recognized me in Alan Jackson's bar. I just went in there to say hi to the staff that was so nice to our team last night. And he recognized me. So Jeff, good to see you. Hope you're enjoying your weekend. Nashville is pretty cool. I'm about to dip off into a side street here, so hopefully I don't get run over or mugged as I weave my way through the crazies before I go to a rooftop bar. I apologize for the setup. I better have some good value and content for you. So I read an article today that talked about loan applications being down the lowest they've been in many years. Rates the highest they've been since 2008. And there's demand destruction. And it was a Yahoo Finance article, and it said sellers are just waiting on the sideline because they feel like they missed the top. And if anyone watches Logan Montashami, the lead housing analyst of Housing Wire, or if you watch Mike Simonson's Altos research, he's out of Orange County. People are not, these are homes. Not everyone looks at their house like an asset, like you trade stocks or bonds or whatever. This is a roof over their head. So if you're gonna sell your home, you're gonna buy another one. So if you're locked into the lowest interest rates, the cheapest money in the history of history, and then you're gonna sell now and then buy at the highest prices in the history of history with the highest rates since God knows when, doesn't make sense, does it? So sellers of homes are looking for another home and shelter to live in. So there's gonna be a major problem with supply. And the listing data is not good. Typically listings this time of year start to improve a little bit, and then they kind of taper down. People don't want to mess with selling their home when you got Thanksgiving or Hanukkah or Kwanzaa or Christmas or New Year's. And then they start to look around the first of the year. So we may be entering the new year of 2023 with just another horrendous supply issue. And so it can distort pricing. It could seem like, maybe there's less buyers because rates are higher, but there's also less sellers because rates are higher. So is anyone talking about seller destruction, supply destruction? Demand destruction is what the Fed wants to cool off inflation. And inflation may have peaked for goods and producer inputs. And that's what the Fed wants. And it can come down quickly. We've already seen a lot of turnover in commodities. We talked about it quite a bit out here on our thing. So thinking about housing supply is very, very important when it comes to the mission of the Fed and when it comes to our housing industry. We may have a lighter volume year next year just because with the cheapest money ever because of the Fed's zero Fed funds rate interest policy, we may have people locked into their house for quite some time. We may be hunkering down in these houses for some time. By the way, if you're an investor and you bought a home, so like maybe 15% of the market is investment property, why would you sell that property? I've been buying property since 2001. I have never sold a property. I've accumulated properties and I rent them out. And I'm actually a pretty decent landlord. I don't take advantage. I only raise rent when like the tenant doesn't mow the grass, so I got to add like a lawn fee, or I got to replace the air conditioning, which by the way goes up in price. But landlords, why would they sell a property? Those are the ones that look at it like an asset. Why would they sell their asset when rent just keeps going up too? And with limited supply on the market, the value of their home should, in theory, go up. Unless, of course, there's less buyers because of the demand destruction that the Fed's doing. So this push-pull between demand and supply is something we'll keep an eye on. It's a weird part of the year. We're in a purchase market. Every lender is going through it. Every lender is realizing that they could be down between 20 or 50% of business versus last year. But I think the roughest time will be over by February. By the way, the loan amount we're rolling out on Monday here at PRMG, a $715,000 conforming loan amount. I know Rocket kind of started that trend and they jumped out in front of it. Last year, I think people were doing it at the end of September or October. Now we're doing it on Labor Day. Okay, cool. So we got larger loan amounts now, which is great. We're rolling that out Monday. We had an awesome leadership conference. Dave Savage, Chief Innovation Officer of Mortgage Coach and Sales Boomerang, spoke yesterday and was around today. Scott Harris, CEO of Experience.com, which we called Social Survey, was around. Eric Levin from Model Match, just giving tons of knowledge. Brittany Hodak talking about super fans. Tony Thompson talking to us about NAMBA and diversifying your growth, helping people be intentional about jumping into our industry from the collegiate level and up. We just had so many great speakers for our retail leadership conference. It was a really awesome week here in Nashville. And I will say RIP Queen Elizabeth II, the longest reigning monarch in England, over 70 years. And her son, Prince Charles, is now the king. And wouldn't that be interesting if Diana and Charles were still together? For those of us that are 46 like me or older, we knew about all the crazy times when Diana passed away. So very, very interesting events going on in England. But back here in America, we are the outperformers of the world. Our economy is outperforming all other economies. Europe is sliding into a recession or in a deeper recession. They just raised their rates to fight inflation. The European Union, I believe, raised the rates by 75 basis points today. And so the Mohamed Al-Arian is an economist. He works for Allianz. He's co-founder of PIMCO, which was the investor behind First Guarantee Mortgage Corporation. He and Bill Gross co-founded PIMCO, which owns a ton of fixed income assets. Very bright gentleman, lives in Corona del Mar in Orange County, and is also the president of Queens College. He said that the overall ultimate level of the economies of the world will be limited because of this recessionary environment, but the U.S. will outperform, and that's a good thing. So as we go into Q4, where retail sales are supposed to pick up, retail balance sheets are still pretty good. We locked in the cheapest rates ever, and our mortgage rates ever, if you're a homeowner, gives you a little bit more income as rents rise to spend on goods and services going into the holidays. So have a great weekend. Football season kicked off tonight for those that care about the NFL. And it is going to be a weekend after Labor Day weekend. Hope you feel blessed and serve your communities. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.